There we go. Good evening, everyone, and welcome to tonight's masterclass. Tonight, we are going to discuss something that all of you requested for me to do, which is to properly explain how to use indicators the right way. So, as we get into the session, first things first, obviously, as always, my name is Francois, and I'm your market analyst here at ATFX Africa. And it is my pleasure to have you here with me for the session on, as I stated, how to correctly use indicators and how they can be used alongside price action and smart money concepts. So before we do get into that, as always, please just familiarize yourself with the disclaimer. Give me a second. So please just familiarize yourself with the disclaimer that's currently on your screen. This disclaimer basically, in short, just states that everything that I will be sharing with you during this session here today is for informational purposes only. And at no point in stage during this session will I be providing financial advice. As long as we are all clear on that, then this is going to be an absolutely fantastic session. So as we are getting into the session here today, I see I already have some comments coming through saying good evening and so forth. Please pop through those messages. Let me know where you are joining from. Let me know where you are logging in from tonight. And if you have any questions during the session, please feel free to ask. I am here to assist and I'm here to help you. Also, please remember to smash that like button. I would truly, truly appreciate that. Now, if you are unable to comment, it is just because you have not subscribed to our channel as yet. So please just remember to subscribe and you will be able to comment then on everything from there on forward. Okay. So tonight we are going to demystify a few popular tools. So the indicators that I want to be focusing on specifically today would be the Williams Alligator. So yeah, this one's pretty interesting. So if you've never used this one, the Williams Alligator, then we're also going to have a look at the Relative Strength Index, as well as the MACD, Bollinger Bands, and the Stochastic Oscillator. But the key here is the following. We are not going to look at indicators in isolation. We are going to look at them as a supporting tool to price action and not as magic arrows telling you what to do. So again, if there is any questions, please feel free to ask. I'm here to assist. The session here is on request, so it is 100% just for you guys. So I want to start things off today by discussing the agenda here for today. Okay, so first of all, as I stated, price action is always the foundation. So we'll start with a quick overview of price action and smart money concepts and why they should be the foundation of everything that you do within trading. Now, then, this can be supported by indicators and not the other way around. Okay, so, and what do I mean by that? So, price action remains your core, and the indicators are there as support. It doesn't really work the other way around where you have indicators as the core and price action as the support. I hope that makes sense. We're also going to talk about the mindset. So what indicators can realistically help with and where traders often misuse them. And then we'll do a bit of a deep dive into those 5 indicators that I pointed out in the beginning. And for each one, we'll look at what it is designed to measure, the typical mistakes traders make with it, and how it can complement price action. So in essence, we will combine indicators with SMC elements like market structure, liquidity, and key zones, and walk you through how a trader might build a rule-based approach. And then we'll end of the evening as always, and hopefully by the end of the session, you would have learned something new. So I do see I have a comment here. Very happy with those selections of yours. I'm glad to hear that. I'm really happy to hear that. Okay, so before we dive in, I want you to ask yourself the following question. Do you currently start with price action first and then use indicators for confirmation? Or do you start with indicators and then only look at the charts a little bit later? Or are you purely making use of indicators at the moment, or are you not using indicators at all? Let me know in the comments. I would love to hear from each and every one of you on those specific topics. So let's start with the foundation, okay? So, and the foundation here, obviously, tonight is still price action. And price action simply means looking at how price moves, identifying swing highs and lows, and then recognizing trend ranges and reveals, which assists us in marking out support and resistance and key levels. And these concepts help us to build on all of these various tools by focusing on how informed money is believed to operate. So in practice, that often means reading market structure, again, higher highs and higher lows in uptrends and lower highs and lower lows in downtrends, watching for break of structure and change of character, identifying liquidity areas where stops are likely to sit, and obviously, which is normally above highs or below lows. And then also, as we stated, marking those supply and demand zones, which are our support and resistance, our order blocks, and points where institutions might be active. So in essence, when we are discussing price action, you want to understand where price is and why it might be reacting before you worry about an indicator saying X, Y, Z. Okay. However, indicators are still very helpful. Indicators help you to measure momentum, see trend strength or weakness, gauge volatility, identify overextended conditions. But indicators do not replace structure, context, and levels. These are very important elements to remember. So for this entire webinar this evening, so for this entire masterclass, think of indicators as supporting actors, not the main characters. Okay. Speaking of indicators, there are a few misconceptions about indicators. Number one, and this is the misconception normally, which is the indicator will tell me where to buy and sell. Now, many traders come in with the expectation that they want a green arrow for a buy and a red arrow for a sell, and that's it. They don't want anything else. They want it that easy. If only it was that simple. But indicators are simply mathematical transformations of price. They don't know the news. They don't know liquidity pools or the bigger picture structure. These things cannot be indicated by indicators. Number two, again, big myth. If I stack enough indicators, I'll get certainty. Adding more and more indicators often just adds more confliction. One is overbought, one is oversold, one is diverging, one is flat. Guys, if your base isn't clear, more tools just create more noise. And this is something very important to remember. Number 3, an indicator by itself is a complete strategy. Couldn't be more false. In reality, indicators tend to work best when they are anchored to a specific setup or used as a filter or confirmation or integrated into a clear trading plan. So the mindset we want here today is, first, I read structure. I check my price action. Then I use indicators to help me time entries, confirm momentum, or filter if I might be entering into a bad trade. With that in mind, let's go indicator by indicator this evening. Okay, I do see I have a comment here. Yes, price action first, then I check what my indicators have to say. I like that. That is the right mindset and the right structure to follow here tonight. So I want to kick off tonight with the Williams Alligator indicator. So the Williams Alligator is, first of all, who here has heard of the Williams Alligator before? Let me know in the comment section. If you've heard of this indicator before, you used this indicator before, pop me a comment. I would love to hear from you guys and would love to get a little bit more interaction. I feel like I'm speaking to myself tonight, even though there is a bunch of people here already this evening. Like I said, I feel like I'm speaking to myself. Um, so kicking things off, the Williams indicator is a trend following indicator built from 3 smooth moving averages. And together they form the jaw, the teeth, and the lips. And I know that sounds funny, but yeah, we're going to deal with that. Okay. So the visual idea is simple. When the alligator is sleeping, the lines are tangled and flat. The market is then often in consolidation. What does that look like? Well, let's have a look here. This is what is, so if you look within this circle here, this is what is referred to as the alligator is sleeping. Here as well, the alligator is sleeping. Why? Why is the alligator sleeping? Because again, the lines are tangled and flat. The market here is clearly in a consolidation phase. And then we get when the alligator's mouth opens. Now, when the alligator's mouth opens, and this is this general area here, the lines fan out and they start pointing in one direction. The market is often in a trend, and now the question comes in, once I understand the indicator that I'm using, how can this help within a price action framework? Well, actually, it's very simple. So first things first, we need to confirm the direction of structure, as always. There's no way around that specific point, okay? So once you have confirmed the direction of structure, so for instance, let's say SMC shows a clear bullish structure, so you're seeing higher highs and higher lows. Let's actually look at an example. So here we can see clear bullish structure, okay? Why? Because you can see higher highs, higher low, higher high, higher low. Again, clear bullish structure. And then we get a break of structure to the upside which you can clearly see here. There's your break of structure, nice clear break of structure to the upside. Now, what do we look for within the Williams Alligator? Here we want to see now, is the lips above the teeth? Is the teeth above the jaw? And if this is all in place, and here you can see there, the lips are above the teeth are above the jaw, and they're all pointing in one direction. You can also see, look at that, they're already starting to fan out. That's exactly what you want to see. You don't want to see them converge like here. You want to see that fan out happen as you get your break of structure. Now, once you see this, well, then the alligator is aligned with the bullish structure. And now you have an extra layer of, let's call it conviction, that the trend is intact and your trade is valid. And now you can start looking at a setups like this, where this is now where your entry comes. You can have a look at maybe a potential SL below these low points and a nice little 2-to-1 risk reward ratio, and simple, straightforward, using my alligator to confirm my entry. Now, this isn't all that the alligator is useful for. The alligator can also assist you in avoiding trading against that main flow. So let's, for instance, say your price action hints at a bullish environment, but the alligator is completely tangled and flat. What does it mean when the alligator is completely tangled and flat? It means the alligator is sleeping. Okay. So let's look at an example about that. Here you can see, look at that. There you can see break of structure. Now, normally break of structure would mean a bullish entry is viable. But now look at your alligator. That alligator is not asleep, it's snoring. Like, I mean, look how flat those lines are. Everything is converging. Everything is all tangled. Now, based on this, it may be indicating that there is a range or an accumulation phase busy building. And if you enter into the market now, you're just going to be wasting a trade and you might get stopped out unnecessarily. Okay. So this will then mean that you can choose to either wait for the alligator to wake up. Okay. That's normally the best option, is wait for the alligator to wake up and align with the trade that you are looking at, or use that consolidation to look for liquidity sweeps or maybe a more refined entry. I hope I'm making sense so far, and I hope this is helping so far. Okay, I see nice, easy indicator to understand now. Thank you. Brilliant. I love that. At least I know we're going on the right track. Third thing that we can use the alligator for is filtering price action setups. Okay. Again, let's, for instance, say you spot a potential supply zone above a price and you're thinking about a short. So basically, you identified resistance and you can see market is retested. There's your first test, second test. So automatically you are looking at your price action and now you're like, okay, I want to enter a short. But now you look at your alligator and the alligator's mouth is wide open and upward, showing strong bullish momentum, as you can see here. Now, again, what are we doing here? First, let's maybe think of being a bit more selective with that short idea. Maybe we can also wait for clearer signs of a change of character before acting. So again, you can also see here, based on our price action, it's just 1-2 test. Like there's just been that retest, but there's no change of character. So again, The alligator is also just warning us. Listen here, it might not be the best idea to start shorting the market, maybe just yet. Okay. So, in essence, the alligator is not telling you buy here or sell there. This is very important to remember. The alligator is not there to tell you this is where you buy and this is where you sell. All it is it's telling you this market looks like it's trending, or this market looks like it's sleeping. So if you combine your price action and your structure, and then using your alligator, you decide what you want to do, then, well, the alligator starts helping you judge when the environment that you are trading is most favorable. Traders, did that give you a better understanding of the Williams alligator? Yes or no? I would love to hear from you guys on that. Okay, let's move on. So next on our agenda for tonight is the Relative Strength Index, or the RSI. Now, the Relative Strength Index is one of the most widely used momentum indicators. And this specific indicator is also known as an oscillator. Why? Because, well, it oscillates between 100 and 0. And within this, it's often associated to identify overbought and oversold levels. Commonly, overbought is above 70 and oversold is below 30. But this is where traders make the biggest mistake. They look at an RSI, they see it's above 70, and immediately, what do they want to do? They want to sell. Or they see the RSI is below 30, and immediately, what do they want to do? They want to buy. Traders, this is without context. That approach is extremely dangerous. In an uptrend, the RSI can say overbought for a long time. And in a downtrend, it can say oversold for a long time. So in essence, the question then comes in, how does the RSI fit into price action? Okay, well, simple. We look for momentum, and we look for momentum around key price action zones. So again, let's look at an example. Here you can see we're looking at gold 1 hour time frame, and it is spiking towards a support level. So in essence, let's say, price action highlights a discount demand zone in a bullish trend. Here we have bullish trend, discount demand zone. This is where we want to buy. This is where that support is. Okay. Now, price trades down into that zone. You can see literally here spiking into the zone, and it's looking to take that liquidity below those previous lows. So here we have those previous lows spiking into that, taking that liquidity there. And at the same time this is happening, RSI dips into oversold region. Again, look at that. Perfect. Dipping into that oversold region right there. Easy to see, easy to use. Okay. Now, when you use that oversold level from where we are here, I mean, even look previously, look at how deeply oversold that was, but we were still far away from the actual support. So yes, it's bounced up a little bit, but it had a hard retracement. So that trade would have just gotten you into trouble. Now you are close to a support level, dipping into that oversold level. And once you do this and using this scenario, then all of a sudden you're not using the RSI blindly anymore. Now it's used to confirm that price action is extended into a deep discounted area. Momentum is stretched to the downside, and a bounce from that support zone is more reasonable. I hope this is making sense. So by utilizing that, now you can look for those entries down here and just look at that. Boom. Beautiful, easy to use setup. But again, adding everything in with regards to your price action and proper confirmation. Okay. I do see I have a question. Are there any specific settings involved? No, every single indicator that I'm showcasing here tonight, I have used on default settings. Okay, so I've used every single one here today on default settings. I have not made one change to anything. Okay, so what is the second way that we can utilize the RSI with price action? This is when we see divergence at specific liquidity levels. Now, what does divergence mean? Divergence means, for instance, if you have a look here, you see your RSI is making a lower low and then all of a sudden a lower high, but your price action is making a lower low and a lower low. So in essence, here the trend is starting to go up, and here the trend is still going down. That is what is known as a divergence. Now, again, just to emphasize this as well, the RSI is very commonly used to spot divergence, okay? And here you can see I just identified just a few, a few bearish diversions and a bullish divergence. But for me, the bullish divergence is the one that I identified that was the closest to the actual key level, because again, we want to utilize the indicator with proper price action. So as stated, just to reiterate the point, divergence commonly happens, for instance, when price makes new higher highs, but the RSI makes a lower high, which is known as a bearish divergence. Or when price makes new lower lows, but the RSI is making a lower high, like what we can see here on the chart at the moment, which is known as a bullish divergence. Now, if divergence appears right before price action is expected to react, for example, like you can see it on the chart at the moment, major supply or demand zone. Here we have a major support zone, or maybe even after a little bit of a stop hunt. So again, this would have been ideal if it was lower here, but it wasn't quite. You could have traded that, for instance, that little spike with that dip if you wanted a little bit of a short-term trade, but a lot of risk because of the fact that you're still quite far from the actual support level. But using that type of confluence where, again, you have divergence using your indicator, and now again you are seeing rejection at your support level, this kind of then confirms. So here you have lower lows, here all of a sudden you have higher lows. So again, confirmed divergence. You can look for a little bit of a trade setup back to that high point, and again, plays out relatively simple and straight to the point. Okay. Makes perfect sense. Perfect. I've heard and experienced that divergence. So I'm glad to hear that as well. I do hope as well, seeing that you've just heard of it previously, that tonight's explanation helps to clarify the divergence as well a bit better. Again, traders, if you have any questions, please feel free to ask. And if you are unable to comment, all it means is you haven't subscribed yet. So all I need you to do is click that subscribe button and you will be able to interact and ask questions. And as always, also please remember to smash that like button. I would truly appreciate that. That one's kind of just for me. Okay. Then there's also a third way for you to make use of the RSI, which is, and this is probably a really nice one because this can help a lot of traders. When you are just chasing after a trade that you shouldn't be trading, okay? So if price has already moved far away from your ideal entry as per your price action analysis, and then you see the RSI is extremely overbought or oversold, that might just remind you a little bit that maybe I've missed my optimal entry, or this is now overextended, or it can keep you from chasing moves that are late. So with the RSI, here's the key that I want you to take away tonight. Use it inside your price action levels, not instead of your price action levels. Again, if there's any questions, please feel free to ask. Moving on to our third indicator for the evening, the MACD. And no, I'm not talking about the McDonald's Big Mac. Okay, so the MACD is your moving average conversions diversions indicator. Yeah, I do know that I just sounded like I swore you, but yes. Now, what is the MACD typically consist of? First of all, it consists of a MACD line and a signal line. So if you have a look here on the chart, your MACD line is the orange one, and then your signal line is the blue line. So the MACD indicator is the one here at the bottom. And then you also have a histogram, the histogram showing the difference between two traders basically using the two different uses of MACD here, which is to gauge trend direction, but also to see momentum shifts. So obviously, if your histogram is green, it's bullish, that's your trend direction. But again, it can also show that directional shift once it changes, just that first initial change from red to green, showing that there might be a trend reversal coming as well. Okay. You can also have a look by using your MACD to spot potential crossovers that may hint at that change in direction within your price action framework. The MACD can also be particularly useful in three ways. Okay. Number one is the MACD can confirm a break of structure or a change of character. So looking at your chart here at the moment, you can see here price breaks above a key swing high. So here you had these high points over here, price spikes up, breaks above that, and we can see that from a price action point of view, there is now that change of character, okay? And literally at the same time, you can see on the MACD that the MACD line crosses above the signal line and your histogram flips to positive, which all the things you can see here at the bottom. Okay, MACD line crosses signal line and histogram pops out green. So everything goes positive. In this case, your MACD is now acting as a momentum confirmation of the structural shift that you are seeing looking at your price action. A second option that you can also use the MACD for is to spot weaker pullbacks. Okay, so here you can see, here you have price moving downwards, and now your question to yourself is this a change of direction or is it just a weak pullback? Now, when price pulls back into a zone or just back from an uptrend, if you have a look at your MACD and the MACD's histogram contracts but does not flip strongly negative. Now here you can see, look at that. Literally MACD line, signal line, histogram, everything is squished into one. Like there's that contraction. That gives you a little bit more confidence here that what you are seeing at the moment isn't 100% valid. It's not currently that we might see a change in trend or that the bullish momentum is stronger at the moment. This is kind of your signal to wait, pause, and wait for confirmation before taking an unnecessary trade setup. Very nice indicator to assist you with this. And then and here you can see, obviously, here you wanted that downtrend, and then all of a sudden market turned back up, going all the way back to the resistance level. A third thing the MACD can actually assist you with is avoiding taking trades that are against strong momentum. So as you're looking at the chart here now, the chart, your price action, everything shows a potential counter trend area. You're at that resistance line, you're seeing that almost, double top here, you're seeing that pullback. And I know a lot of you already starts itching. You want to start entering those cells. Now, then when you look at your MACD, it's strongly aligned with the continuation of this trend. Your histogram is bright green. Your MACD line is above the signal line. Everything's pointing up. So in essence, what should you do here? Well, in my opinion, you might want to decide to stand aside until you see either momentum cooling or you see a clearer shift. Again, the idea is not trade every MACD cross. It's use the MACD to confirm or question what your price action is showing you. And if you can use it to do that, so for instance, when you see a certain price action set up, use your MACD indicator. If your MACD indicator confirms what you are seeing, brilliant, go for it. If your MACD indicator questions what you are seeing, that might be your signal to just pause for a second. Okay. And here you can obviously see if you took that sell, this would have gone really bad because it just broke above and then just continued on that upward trajectory. Okay. Awesome. Thank you. Not a problem. Sorry, joined late. Which indicator is used? Okay, so currently we just discussed the MACD indicator, but up until this point, we have also discussed the Williams Alligator, and we also discussed the RSI. If you have missed that, please feel free to watch the recording after the session. Okay. We are also still going to discuss the Bollinger Band as well as the stochastic indicator and how to use that in conjunction with your price action. So don't go anywhere. Stick around for that, but you can always just revisit the indicators that you missed in the beginning. Okay. Just as a comment here, MACD indicator almost feels like a combo of indicators in one. Well, the MACD indicator is made up of quite a few things, which is why it is so widely used by traders and why it's such a fan favorite. So our second last indicator for today, which is the Bollinger Band. Now, the Bollinger Bands are built from a moving average in the middle, okay? And then from there, you'll see it has an upper band and a lower band. The upper and lower bands typically sit a set number of standard deviations away from the current price, which means they expand and contract based on volatility, okay? Common uses for the Bollinger Band includes identifying periods of low volatility. This is identified as squeezes, okay? So when you see a Bolly Band squeeze, that indicates a period of low volatility. We're going to have a look at an example of that just now. And then you also have spotting, price touching or piercing the bands. So actually breaking through the band and then retracing. And again, we're going to look at this as well. And then obviously using all of this within your price action, let's have a look at a few examples. So here you can see price is approaching that major price action level. So you got that resistance. And now you are also at the same time seeing the Bollinger Bands are very tight and you can see that squeeze appearing. Now, this may be a sign that the market is coiling. So normally when you see a Bolly Band squeeze, it's kind of like a spring that's compressing and compressing and compressing. And the moment that spring releases, market just spikes in one direction. So once that coil releases, that larger move then follows. And the direction of that move is, at this point in the stage, still to be determined by structure, but the squeeze is warning us that volatility expansion is likely to come really quickly. So once the squeeze takes place, all you are waiting for is either a break to the bottom or a break to the top. And here we got that break to the top. So what do? Once we get that break, you can enter your buy. That kind of now confirms. So here you had your resistance. Now you break above your resistance. This confirms your break in that direction based on the Bolly Band squeeze that you got. Again, even look down here. Look at that converge, like look at that squeeze coming in and getting tighter and tighter and tighter. And once it broke, spiked up all the way to that one. Here, squeezed, broke, and then spiked all the way to the next resistance level. So first way where we can use Bollinger Bands in conjunction with our actual price action. The second one is when we see liquidity sweeps. Now, frequently we'll see sharp moves that grab liquidity above or below lows, which will also push price outside of the upper or lower band of the Bollinger Band and then snap back inside automatically. Now here you can see, look at this. Broke out of the Bollinger Band, snap back immediately. So already there. But this is also happening near a key price action level. So again, all of this is helping. So with that wick rejecting outside the band, it can act as further confirmation that the move was a stop run rather than the start of a brand new trend, which in this case, then from here, you can look at a short position. And for me, I normally just trade within the bands with regards to this. And you can look for a short position down to the bottom of the band, which you can see played out relatively quickly and quite nicely on this specific move. And then we have a third option, which is that reversion inside a range. Now, A lot of times you will see obvious ranges where Bollinger Bands can highlight when price is stretched towards one extreme. Now, if you combine this with clear range boundaries, liquidity pools on each side, and price action inside the range, the bands can help you avoid selling at the bottom of a range or buying at the top without context. Okay. So by using these ranges again, that can assist you from not entering a sell at this level here where you're at the bottom and there's a good chance for a retracement higher, or entering a buy at this specific area here because again you're at the top of the range and there's no squeeze, bands are nice and far apart. So just assisting you to make better choices. But once again, band behavior, so Bollinger Band behavior plus price action plus liquidity can all form part of a much more complete picture. However, within the Bollinger Band, band touches by themselves mean very little. There's a lot of people who believe you can just trade from one side of the band to the other side of the band. Yeah, and what happens when you get these types of consolidation? Again, you're not truly following your price action. Is just going to get you into trouble, where if you are combining your Bollinger Bands with proper core price action, it just makes everything so much better. I do see I have a comment here. Big fan of the Bollinger Band. Learned it by comparing it to a hose pipe. Whenever the squeeze is, force is building up. Lol. Perfect. Yes. Again. And traders, then that brings us to our last indicator for this evening, which is the stochastic, which, similar to the RSI, is also known as an oscillator. Now, the stochastic oscillator is another momentum tool typically used to identify also overbought conditions. So when the oscillator is near the top of its range, that is overbought, or oversold conditions when it is near the bottom. It's especially popular for short-term swing timing. So all my scalp traders out there, and I'm one of them, but for scalp traders, this is specifically a very useful tool. Now, how do we use this in conjunction with price action? Number one, stochastics can assist us in timing entries better. So looking here, you can see market structure is bullish, but we do have this retracement, and we've marked out our demand zones where we expect price might react. As price trades into that zone, you can see here, goes in, rejects, pushes up. And now what do? We look at our stochastics, and the stochastics is also pointing beautifully at the same time in oversold, but not just oversold. And this is why I kind of like the stochastic a lot more sometimes than the RSI, because it has that extra layer of confirmation. So it's oversold, but it also starts to turn up. And you can see when it turns up, the blue line crosses above the orange line. So it kind of gives you that little bit of a confirmation that the trade is ready. And again, just placing stops below these previous low points over here, and a beautiful little setup that follows by, again, just having a look at our price action where we are, waiting for the stochastic to give that confirmation, and then take things from there. Second way that we can use the stochastic is to identify short-term exhaustion, okay? So let's, for instance, say we see something like this, where we see that change of character, we see that movement in one direction from a price action perspective. And now you're wondering, should I enter a sell and trade this down to the support area down here? Well, this is when we need to start asking questions. So yes, you can see here that price has aggressively swept that low, but now you also see the stochastic spike into oversold territory and then turn up. Look at that little peak here at the bottom. Look at that. Oops, turns back up. Now, this might help you to firstly identify or confirm that the move is exhaustive. Okay, it's run out of steam. And or you can align this with the idea that a stop hunt into liquidity is taking place before a further move can continue. And again, this normally just means there might be a little bit of retracement before the general trend continues. And again, look at that, just a little retracement, and obviously trend followed from there on forward. The third way that you can make use of the stochastics in conjunction with price action is avoid blind counter trend trades. Now, I know a lot of times it is super enticing to enter these trades at highs or lows, but sometimes, or even, and again, if you use it the other way around, a lot of times people are like, yeah, but I can just sell when the stochastic gets too oversold. What happens when the stochastic gets too oversold and just stays oversold? Now you can see here, stochastic was oversold from this general area down here. And what happened? Price ticked up, price ticked up, price ticked up, price ticked up, price ticked up. And you would have hit stop loss on 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 stop loss. But if you use the two together, so here you see prices approaching that resistance. And once it actually gets to the resistance, you see, okay, oversold. And this gives you that extra clarification. So we're not just entering when stochastic gets to oversold. No. But now stochastic has been oversold for a while. Again, that coil, similar to the Bollinger Band, there's been a lot of buildup. I mean, even look here. Stochastic stayed oversold for a long time. What happened after that long time? Big drop. So what can I kind of assume here at this point in stage? This is kind of, and I normally use it like this to get those sniper entries. And I mean absolute sniper entries where you get that sell just under the resistance or just on top of the support, really small stop loss, and like a 5-to-1 risk to reward ratio. And here you can see, boom, beautiful, played out. Very easy setup. But again, it normally happens. You see, you get that coil, starts compressing. You wait, you wait, you wait, you wait. Place your limit order at the actual resistance. Price taps into that actual zone and just moves back really quickly in the opposite direction. So as stated, like the RSI, the stochastic is most powerful inside a framework, not on its own. Okay. Stochastic is another big favorite of mine. Absolutely love it. Okay. Whew. Let's wrap up this evening. Okay. So putting everything together into a simple process can assist you in adapting your own plan to be more profitable. A structured flow might look like the following, start with market structure, and then you have a look. Is my market structure trending up? Is my market structure trending down? Or is my market structure ranging? Then you have a look. Where are my major highs and lows? And where are the obvious liquidity pools? Then you have a look, which zones do you consider important supply and demand zones? Now, step 2 within your structure, identify your price action bias. Are you looking to buy from discount in bullish structure, or are you looking to sell from premium in bearish structure? Where is your ideal point of interest? And once you've established this, use indicators as filters and confirmation. So for instance, Williams Alligator, is the mouth open in the same direction as your price action bias? Or is it flat and tangled and still sleeping and hinting at consolidation? Or you might decide to use the RSI, and then again, is my momentum extended into your zone, or is there any diversions at the level that you are currently caring about? Or number 3, you might want to use the MACD indicator. Here you might ask yourself, is momentum confirming the break of structure, or does it just suggest the move is weakening? Or if you are making use of the Bollinger Band, is volatility contracting? So is that spring coiling, before a larger move? Or did price spike outside the band and touch your key level, and now there's a trade opportunity there? Or lastly, stochastic. Is it helping you fine-tune timing inside your zone? And especially on lower time frames for scalp traders, stochastics is a beautiful thing to use. Then how do we expand on our structure? We expand by defining entries, stops, and management rules. So based on your plan, you can define how you will enter. Are we going to use limit orders at zones, or confirmation via a candle or indicator turn? Then where do your stops go? Beyond the liquidity level, or are you going to use some other form of price action to identify this? Or again, number 3, how you'll manage the trade. Are we going to take partial profits? Are we moving stops? Are we trailing? Then we move into the 5th part of our structure, review and refine. After the fact, so after everything has now taken place, review. Did the indicator that I used add value, or did they just distract me? Was I using them as confirmation, or was I trying to trade the indicator by itself? Or did you align the indicator well with price action structure most of the time or all of the time? By using this review process, you start to develop your edge. Traders, and I think with that, we wrap up this evening session. I do see here, super awesome. Thank you so much. Glad I'm using them correctly. Thank you, Francois. Thank you for this evening session. Found it interesting and informative. Love that. So as I said, that wraps up our session. That wraps up tonight's masterclass with regards to price action and how to correctly use them with indicators, okay? Always just remember that price action is our foundation. Indicators should support what you see in structure, not replace it. The Williams Alligator helps you see trend versus sleep, or, use it to confirm the market is trending or consolidating. RSIs and stochastic highlights momentum. MACD adds layers of momentum confirmation. Bollinger Band shows volatility and extremes. Indicators are tools, not signals, okay? Use them correctly and they can filter bad trades, support your bias, improve timing, Used incorrectly, they can confuse you, make you chase entries, and distract you from actual story or the actual story price is telling. Okay. Just to take this one step further, pick one or two of these indicators, not all five at once, please. I'm begging you. Okay. Choose one price action setup you already like. Spend time on your charts and see how that indicator behaves at certain price action zones, around liquidity grabs, during breaks of structure. Build screenshots, build notes, build your own library of examples. The goal is not to find a perfect indicator. The goal is to build a consistent process where indicators genuinely support your understanding of price, not replace it. Okay. Traders, thank you so much for joining this evening. I really do hope you found this beneficial. Until next time, stay sharp, stay focused, and trade smart. I'll see you in the next session.